Let's go through the accounting cycle for a merchandiser. The accounting cycle for a merchandiser is going to be the same as that for a service company. However, there are a few adjusting entries and a slight change in your closing entry. So let's go through this accounting cycle again. You know that the accounting cycle starts with analyzing the transaction. Then we're going to record the transaction in the journal. Next, we're going to post the transaction to the ledger. Then we're going to prepare a trial balance. Remember, steps 1, 2, 3, and 3 are done for every single transaction during the accounting period. Step 4 onwards are done at the end of the accounting period. Step 5 is adjusting entries. These are entries done at the end of the period to adjust certain accounts that are not correct. If you remember from before, our adjusting entries included deferrals, we had deferred expenses, deferred revenues, and then we had accruals, accrued expenses, accrued revenues. There's an additional adjusting entry for a merchandiser that we did not cover before. So let's go through that next. As you already know, a merchandiser has inventory. Every time a merchandiser buys inventory, we make an entry in the inventory account. Every time a merchandiser sells inventory, returns inventory, we also make entries in the inventory account. So we have a record of inventory in our books. You know that the ledger is where we find our balance of our accounts. And let's say that our inventory account had a $100,000 balance. We also have another place where we have inventory. The physical inventory is kept somewhere in the warehouse. So let's assume that at the end of our accounting period, we go and physically count our inventory that's there in the warehouse, and we found that our physical count revealed that we had $99,500 of inventory. Now the question is, which is the correct amount? Is it our book balance of $100,000 or the physical count of $99,500? Well, the physical count is the correct amount because that is physically what we have. The difference is what we call shrinkage. Shrinkage is loss due to either theft or misplaced items, things like that. So the difference we call shrinkage. And just like supplies, if you remember a while back we did an adjusting entry for supplies, inventory shrinkage also needs an adjusting entry. Our accurate count is the physical count of 99,500. So we need to make sure that we bring the T account balance in our inventory down to that physical count amount. So let's take a look at our inventory account. We have a balance of 100,000. The normal balance of inventory is debit, so we're going to show it as 100,000 debit here. But our actual count, our actual amount of inventory we have is 99,500. So we need to bring down this balance to 99,500. How do we do that? We credit inventory for $500 on December 31st, which is our last day of our accounting period. The debit goes to cost of goods sold. So we're going to debit cost of goods sold for $500 on December 31st. Basically, we've lost $500 of inventory. Either somebody's stolen it, or we've misplaced it, or we've accounted it for it wrong. And how do we account for it? In our books, we write it off as an expense by increasing the cost of goods sold by $500. This is an additional adjusting entry for merchandisers. Now let's continue with our accounting cycle. After our adjusted trial balance, we prepare our financial statements. After our financial statements are prepared, we close the books. We have our closing entries. Now our closing entries for merchandiser are also a little different than we've seen before. Let's take a look at that next. The closing entries for merchandiser are also a 4-step process. Step 1 is to close all credit balances in temporary accounts to income summary. Earlier, we said close all revenue accounts to income summary. Now we're expanding it a little and being more accurate and saying close all credit balances in temporary accounts to income summary. Well, what are the only temporary accounts that have credit balances? It's only revenue accounts. So again, here we're only still looking at revenue accounts. Step 2 says close all debit balances in temporary accounts to income summary. Earlier, we only had expense accounts that had debit balances, but this time we have some more. If you remember, our cost of goods sold, which is new, it's an expense account, along with all our other expense accounts, gets closed out to income summary. Also, we have our contra revenue accounts that have debit balances. So we're going to close out our two contra revenue accounts, which are sales allowances, sales returns and allowances, as well as sales discounts. So for a merchandiser, we're going to close out our expense accounts, including cost of goods sold, and our contra revenue accounts together to income summary in step 2. Step 3 and 4 did not change. Step 3 says close income summary to retained earnings, just like before. And then step 4 is to close dividends to retained earnings. Now we can continue with our accounting process. There's only one more step left, which is post-closing trial balance. As you can see, the accounting cycle steps for a merchandiser or a service company are identical, just that we have few additional things that we need to take care of when it's a merchandiser. Remember that we have shrinkage for adjusting entries, and we have some additional temporary accounts in our closing entries.